In the world of investment, exchange-traded funds, ETFs, have gained immense popularity over the past few decades. These versatile financial instruments offer investors a unique blend of diversification, liquidity, and simplicity. Whether you're a seasoned investor or just starting out, understanding what ETFs are and how they work is essential to making informed investment decisions. An ETF is a type of investment fund that trades on stock exchanges, similar to individual stocks. It is designed to track the performance of a specific index, sector, commodity, or asset class. ETFs are known for providing investors with exposure to a diverse range of underlying assets, allowing them to gain market exposure without the need to purchase individual securities. ETFs operate based on a simple yet effective structure. Let's delve into the mechanics. Creation and redemption. An ETF is created by an authorized participant, usually a large financial institution, through a process known as creation. The authorized participant assembles a portfolio of securities that matches the index the ETF aims to track. This portfolio is then exchanged for shares of the ETF. Conversely, when an investor wants to exit their position, they can redeem their ETF shares for the underlying securities, a process known as redemption. Tracking an index. Most ETFs are designed to mirror the performance of a specific index, such as the S&P 500 or NASDAQ. This is achieved by holding a proportional or representative sample of the securities within that index. For instance, an ETF tracking the S&P 500 might own shares in the same companies and in the same proportions as the index itself. Passive management. Most ETFs follow a passive investment strategy. This means the fund manager doesn't actively select securities to buy or sell. Instead, they aim to replicate the performance of the chosen index as closely as possible. This approach tends to result in lower management fees compared to actively managed funds. Diversification. ETFs offer inherent diversification benefits. Since they hold a basket of securities, investors can achieve exposure to a wide range of companies, industries, or even geographic regions through a single investment. This diversification helps spread risk and reduces the impact of poor performance from any individual security. ETFs come in various flavors to suit different investment objectives and risk appetites. The following are some common types. Equity ETFs. These ETFs track stock market indices and provide exposure to various sectors, sizes, small cap, mid-cap, large cap, and geographic regions. Bond ETFs. These track fixed income indices and offer exposure to government and corporate bonds, offering investors a way to generate income and balance their portfolios. Sector and industry ETFs. These focus on specific sectors or industries, allowing investors to target their investments in areas such as technology, healthcare, energy, and more. Commodity ETFs. These provide exposure to commodities like gold, oil, agricultural products, and others, without the need for physical ownership. Inverse and leveraged ETFs. These are more complex and not suitable for all investors. Inverse ETFs aim to profit from a decline in the underlying index, while leveraged ETFs use derivatives to amplify returns, both on the upside and downside. Due to their complexity, these ETFs involve higher risks. International ETFs. These offer exposure to markets outside the investor's home country, allowing for international diversification. ETFs offer several advantages that have contributed to their widespread popularity. Liquidity. ETFs trade on stock exchanges throughout the trading day, just like stocks. This provides investors with the ability to buy and sell shares at prevailing market prices, enhancing liquidity. Low costs. Due to their passive management strategy and lower turnover, ETFs typically have lower expense ratios compared to actively managed funds. Diversification. As mentioned earlier, ETFs provide instant diversification by holding a broad range of underlying securities. Transparency. ETF holdings are disclosed daily, allowing investors to see exactly which securities the fund holds. This level of transparency is often lacking in traditional mutual funds. Flexibility. Investors can use ETFs for a variety of purposes, including long-term investing, short-term trading, and risk management. While ETFs offer numerous benefits, investors should also be aware of potential risks. Market risk. Like all investments, ETFs are subject to market fluctuations. If the underlying index or asset class performs poorly, the ETF's value will also decline. Tracking error. While ETFs aim to replicate the performance of their underlying index, there can be small deviations known as tracking errors due to factors like fees, trading costs, and market conditions. Liquidity and bid-ask spread. While most ETFs are highly liquid, some niche or less traded ETFs might have wider bid-ask spreads, which can impact the cost of trading. Complexity. Certain ETFs, such as leveraged and inverse ETFs, can be complex and involve significant risks. These products might not be suitable for all investors, especially those who are less experienced. Tax implications. Depending on the structure of the ETF and the country's tax regulations, investors might be subject to capital gains taxes when ETF shares are sold. ETFs have revolutionized the investment landscape by providing investors with a flexible, cost-effective, and diversified way to access various asset classes and markets. With a solid understanding of what ETFs are and how they work, investors can make more informed decisions about incorporating these versatile financial instruments into their portfolios. As with any investment, it's essential to conduct thorough research and consider one's investment goals, risk tolerance, and time horizon before adding ETFs to an investment strategy. Thank you for watching. Like, comment, and subscribe for more.